Hi, I'm Graham. I'm the Insights Manager at finder.com.au. Well, the RBA cut the cash rate again today for the third time this year. We're currently at 0.75%. That's half where we were at the beginning of the year. What's in store in the future? Are more cuts to come? What does this mean for homeowners? Are savers in trouble? We're going to round down all of this with our 7 predictions following the October rate cut 2019. So number 1 is that we are going to see more cuts to come. 3 we've already had, but when we asked economists how low they think the cash rate's going to go before it starts to increase, the biggest group, 70% of them said 0.5%, which means one more cut in the pipeline. When's that going to happen? February is the most popular month in terms of forecasting it, so watch this space. Number 2 on our list is that sentiment will continue to decline. We've asked economists for a year and a half now for their positive or negative economic outlook when it comes to 5 different economic factors, and we're seeing the lowest results ever right now for unemployment and wage growth. That follows some figures that have come out recently showing an uptick in unemployment in Australia, and that's despite more jobs being on the market. The reason is most of the new jobs are part-time side hustle roles, so there isn't enough jobs out there. If there's not enough jobs, it means that wage growth is also going to be stalled, so looking a little bit bleak for those 2 factors in the near future. Number 3 is that the housing market recovery is a long way off. We've seen prices continue to increase slightly in Sydney and Melbourne. Those stock volumes are low, meaning prices are being artificially increased because there's less stock on the market. But we asked economists how long it will take in other Australian capitals for prices to start to increase, and they said between 5 and 9 months. You can see the exact figures on the screen there, but one thing's for sure, the full housing market recovery is still a fair way off. Number 4 is that quantitative easing may be on the cards. Now, what is QE? Well, quantitative easing is what happens when a central bank basically runs out of options and isn't getting an impact from lowering the cash rate. What happens is that the central bank will create new money. They used to physically print it, but now it's just created on a computer system. They use that new cash to buy low-risk investments like government bonds, reducing the interest rate on those products and making them less appealing to investors, and that encourages investors to invest in higher risk investments like the stock market, which helps boost companies' coffers, which helps boost employment, which helps boost the economy. And once the economy recovers, those bonds are then sold by the central bank and the profits are deleted, so the net amount of money in the economy remains the same in theory. So why do we think QE is more likely? Well, basically that's what our economists are telling us. We've seen 1/3 of economists this month saying it was likely, up from 20% earlier in the year. Also, there's been some communication from the RBA that this might be on the cards in the near future. Number 5 is that we may actually see a stock market boost despite the doom and gloom. That's because once the quantitative easing, if it kicks in, once that money is created, it tends to be invested in the stock market. We saw an increase in the stock market in the US and the EU post GFC after they introduced QE, so that may well happen here. The last 2 items on our list are kind of obvious. If you see a cash rate cut, we need to talk about mortgage holders and we need to talk about savings, because the cash rate directly impacts those 2 types of products. So number 6 is that homeowners are going to see some savings in their repayments. The average homeowner in Australia will save about 19k. That's for a kind of $380,000 loan. Obviously, if you're buying a new house, you'll save an awful lot more, and that will double if we see another cut in February. That's following savings we've seen earlier in the year. Of course, the central bank are going to be hoping that households don't save that money and instead plow it back into the economy, because savings accounts are becoming far less good value. So 7, our last point on the list, is kind of connected to the last one. It's that savings accounts in Australia are going to continue to decrease in value and become more useless. In fact, the savings account rate, the online savings account rate right now is about half what the cash rate is. Following a decrease in that rate, the banks have pushed it into the ground in 2017. The reason they've done that is because they're trying to encourage customers to move across to bonus savings accounts instead, where you put money in, but it's locked in. You generally can't take that same amount of money out every month without losing your interest rate. So 2 products there that are not ideal. The maximum interest rate there, 1.75%. But there are products on the market which offer better value than both of these. If you look for the smaller banks like ING Bank and ME Bank, and some of the new neo banks like 86400 and Up Bank, these guys are offering online savings accounts with no fees, with interest rates from 2.2 to 2.5%, as long as you put your money in and do your day-to-day banking with the banks, but generally there's no restrictions on these accounts. How much difference does that make to your saving? Well, the average Australian, according to our calculations, on the basic online savings account will make about $500 in interest in 3 years. On these accounts, up to $3,000 in interest. So if you want to make the most out of the small interest rate you can get from your savings, these are the products to look at. We have more information and a full write-up on all of these products in the links below. So there's our 7 updates following the RBA decision in October 2019. Things don't look great on balance, but what's actually going to happen? Will we see another cut in February? Follow all the updates for the economy on finder.com.au.